Okay, so today we're going to talk about something pretty exciting, the Indian stock market. But look, this isn't going to be some dry, boring lecture. We're framing this as a journey, an adventure, really. One that could lead to serious wealth creation. And honestly, it's way more achievable than you might think. Let's get right into it.
First, I just want you to look at this number, 13x. What if I told you that this simple figure, well, it tells one of the most incredible wealth creation stories of the last 20 years. It's a number that should get you really, really excited.
Because that's exactly what it is. 13x is the growth of Indian stocks. To be specific, the Nifty 50, that's the index of the top 50 companies on the National Stock Exchange, it has multiplied investors' money nearly 13 times in just 2 decades. That works out to an average return of about 13.7% every single year. So yeah, the potential is absolutely massive. So here's our roadmap for this journey. We're going to start with the lore of the market, then talk about the bear traps that catch so many beginners. After that, we'll get some lessons from the absolute masters of the game. Then, we'll set you up with your own investing toolkit. And finally, we'll tackle what might be the toughest part, winning the mental game. You know, every great journey has its obstacles. And when you're starting out in investing, most of those obstacles are, well, ones you create for yourself. We're calling these the beginner's bear traps, the classic mistakes that trip up almost everyone when they're new to the game. I love this quote. It's from a new investor on Reddit. And it is just so real, isn't it? That feeling when you think you've got it all figured out, you think you're making these brilliant moves, only to realize later you were just, messing up. I think we've all been there. And here are those mistakes in a nutshell. Chasing those to-the-moon hype stocks you see online, yep, that's a big one. Trying to perfectly time the market, buying at the absolute bottom and selling at the top, almost impossible. And what about putting all your money into just 1 or 2 companies? So risky. But maybe the biggest mistakes of all are ignoring the risks and, crucially, just keep putting off a consistent savings plan. Okay, so how do we sidestep all those traps? Well, the best way is to learn from the people who've already navigated this exact path for decades and came out on top. It's time to get some wisdom from the masters. This is probably one of the most famous quotes in Indian finance, and it comes from the legend himself, the late Rakesh Jhunjhunwala. It's just brilliant, right? The market doesn't reward the person who's trying to get rich quick. It rewards the one who can wait. It's a game of patience, pure and simple. And his whole philosophy was really built on these 5 core ideas, these mantras. Things like investing for the long term, trusting the people running the company, having the discipline to stay the course when things get choppy. And yeah, just like that investor on Reddit, being humble enough to learn from your own blunders. But what's really interesting is that there's not just one right way to do this. Here we've got 2 different but equally powerful styles. On one side, you have an investor like Dolly Khanna, who's a growth hunter. She's looking for those smaller, undiscovered companies that could explode in value. On the other side, you have Jhunjhunwala, more of a value seeker, looking for really solid, well-established companies with strong foundations that he could hold for a very long time. All right, enough philosophy. We've learned from the mistakes and we've learned from the masters. Now it's time to get practical. Let's start building your personal investing toolkit with strategies you can actually use. And the first tool we're putting in that kit, maybe the most important one, is the SIP, the Systematic Investment Plan. It sounds fancy, but it's dead simple. All it means is that you invest a fixed amount of money, say every single month. It's about building a habit, a discipline. It's not about being rich, it's about being consistent. So why is this so powerful? Well, it's because of something called rupee cost averaging. And this is the magic trick. When you invest that same fixed amount every month, your money automatically buys more shares when the price is low, and it buys fewer shares when the price is high. Over time, this actually lowers your average cost per share, and you do it all without having to stress about timing the market. It's brilliant. And if you need proof that this stuff works, just look at these numbers. This is the real-world performance of some well-known mutual funds in India. Just check out those 3- and 5-year returns. We're talking about annualized gains of over 20, even 30% in some cases. That is the incredible power of long-term, consistent investing. So look, if you only remember one thing from this whole section, make it this. It all boils down to a simple truth. Your success will come from the time you spend in the market, not from trying to time the market. Patience and consistency will beat frantic guesswork every single time. Okay, so we've got the tools, we've got the strategies, but now we come to the final boss, ourselves. The biggest challenge in investing isn't picking the right stock, it's mastering your own psychology. This is all about winning the mental game. There's a whole field of study around this. It's called behavioral finance. It's basically where psychology meets your money. It helps us understand all the weird, irrational biases and emotions that make us do dumb things, like panic selling at the bottom or buying into a crazy hype bubble. It's the why behind our mistakes.
And a perfect example of this is the herd mentality. We all know this feeling, right? It's FOMO, the fear of missing out. It's that nagging voice that says, hey, everyone else is buying this stock and getting rich, you better jump in before it's too late. It's an incredibly powerful impulse, especially in the age of social media, and learning to resist it is key.
So that brings us to the big question, doesn't it? Knowing that these psychological traps exist is one thing, but what do you actually do about it? How do you tune out all that noise and invest with real discipline, based on a plan, not just on hype? Well, this is your path. It really is a summary of our entire journey today. Start as early as you possibly can. Let compounding do its magic. Be relentlessly consistent. Use those SIPs to automate your discipline. Spread your bets. Diversify. Stay patient. Think in decades, not days. And most importantly, get a handle on your emotions. Make decisions with your head, not your gut. So there you have it. We've seen the traps, we've met the mentors, and now you have the tools in your hands. You understand the mental game you need to play. So the only question left is the one right here on the screen. What is your investor's journey going to be?